Here's one of my high growth investment portfolios I created back in November. I started this account with $20,800. You can see I've grown this account by over 47% in just a couple months. Here's another high growth portfolio I put together a few months ago. I started this account with just under $120,000. And in that same amount of time, in just a couple months, I've grown this account by over 33%. These are up a few percentage points beyond this just yesterday, and I expect that they'll recover soon. Today, I'm going to be going over some investment advice by Warren Buffett and how it relates to my own personal investment strategy. I'll be telling you exactly how I find the stocks in my own personal portfolio. And I'll be telling you how I evaluate the core concepts of each stock before I make a purchase. But most importantly, I'll be talking about how to invest over the next year. I honestly think the strategies I'll be discussing today are crucial to learn. If you are planning to invest in the stock market, you need to know about these. I'd even say take out a piece of paper and take some notes today. If you're new to the channel, welcome to the Income Series where we discuss all things about finance, business, and investing. I'm Brian Clark, living down here in Puerto Rico. I used to have a career as a nurse anesthetist that I left after starting several online businesses. Now I come onto YouTube to share how I achieved financial independence, talk about all the new ventures that I'm doing, and share with you the different things I'm learning along the way. I want to say thank you to all those that always tap that like button and share their thoughts in the comments section down below. You know that we are doing this for more than just the YouTube algorithm. We are really trying to create a community here where we help each other out. If you haven't yet, turn that like button blue. Videos like these that bring original value take a really long time to put together. Many of you know that I talk quite a bit about stocks on this channel, but I'd never want you to go out and buy a stock simply because I talk about it being in my own personal portfolio or there's things that I like about it. Buying a stock simply because somebody else recommends it has the potential to end very badly, and it's just simply a bad investment strategy. You need to understand that chasing fads and the current hot stock in the market works until it doesn't. Young investors especially will only have known the longest running bull market ever, followed by the shortest recession ever, and may even have had some successes with a few Hail Mary all-in investments during the longest bull run and fastest recovery ever. If that's you, I think it's great that you made some money, but I want you to keep that money and be smart about your investment strategy moving forward. So to get started, I want to cover Warren Buffett's #1 rule with investing: never lose money. And his #2 rule is to never forget the first rule. You don't need many big losses in order to completely destroy your investment portfolio and make it extremely difficult to recover. Now, why is this? It's because it's easier to lose 50% of your money than to make 100% on your money. And I'm going to be showing you a chart that explains the rules behind the losses in the market. If you lose 50% of your money, then you literally need to double your money just to recover to where you were at when you started. This essentially means that you need to be right twice as often as you are wrong just to break even in that scenario. Now, it's even worse if you plan on taking on more risk. You can see here, if you take on risk where you could lose 90% of your portfolio, you need to be right 9 times out of 10, with the potential of 900% upside just to break even. I want my next words to stick in your brain. Even the most educated investors often fail using high-risk investment strategies. And it's due to the unpredictable nature of stocks and the stock market. Not only are stocks and their industries unpredictable, but so are governments and their economic policies. There's always manipulation of the stock market. Here are a few examples. One example is capital raises. You could do a lot of research and invest in a good company at a very good price, but the very next week they decide to do a capital raise, which means they sell more stock, which dilutes the value of your stock and makes it go down. Another example are Federal Reserve interest rates. You can invest in a good company and literally the next day the Fed could raise interest rates. Another example is government regulation. You can invest in a great company and then all of a sudden the next day the government decides to set new regulations that negatively impacts the industry. The average investor, even one that follows the market every single day, is going to be ignorant of several existing and potential influencing factors. And remember, you're not a hedge fund sending in a team of business consultants to evaluate these manufacturing plants. And you have to accept that your stock picks are always going to be made on incomplete information. Some risk is always going to be present. So since you can't get rid of these risks, how is it that you can at least mitigate them as an investor? And the answer is you need to stay well diversified. I cannot stress this enough. Stay diversified. I believe the number one biggest mistake made by new investors is not having a well-diversified portfolio. Don't make that mistake. I did when I first started. I had to lose a bunch of money following bad advice before I figured out what worked for me. There are too many people that create their first brokerage account because of hype and FOMO and go all in on the newest fad stock being pumped up by the media. These people often lose, and they often lose big. Now I keep a portfolio of 40 to 50 stocks that each make up about 2% of my total portfolio. Sure, this is more work. Before I buy into a stock, I need to research each company and make sure that I'm familiar with it. But I think you'll realize when you invest in a company, you're much more motivated to familiarize yourself with how it works and how it's going to grow over time. Then, when you rebalance your portfolio over the next couple of months, you'll know which ones to cut out and which ones to go heavier into. And maybe you even found some additional stocks that you want to add into your portfolio. Now, I know what some of you are thinking. Now, Brian, I don't have tens of thousands of dollars to invest in several stocks and build a diversified portfolio. Well, fortunately, there are some great solutions for you. M1 Finance will allow you to build a well-diversified percentage-based pie of stocks that you can invest in. This pie is made up of fractional shares, so even if you don't have a large amount of money to invest, you can still invest in expensive stocks. As an example, you can build a pie that's, say, 3% Apple, 4% Tesla, and so on until you make up 100% of that stock pie. In fact, there are already pies available that have a long history of beating the market that you can choose to invest in. Investing in some of these M1 Finance pies might actually be a great option if you don't want to be constantly managing your own portfolio. And one of the other nice things about M1 Finance is it's extremely easy to rebalance your portfolio. Rebalancing a portfolio is a common investment strategy where you take profits on stocks that performed well, and then those profits are then allocated to invest in other stocks that maybe didn't perform as well. This ultimately helps keep the diversity of your portfolio balanced and reduce volatility. Now, one of the cool things about M1 Finance is you can change around that pie whenever you want. So if you want to go more bullish into one stock and sell off another stock entirely, you can do this very easily. Another option for diversifying your portfolio is to invest in what's called exchange-traded funds, or ETFs, and also mutual funds. These are a portfolio of stocks managed and sold under a single stock ticker symbol in the stock market. I personally prefer ETFs over mutual funds because they generally have lower management fees. You can find ETFs and mutual funds that essentially put together similar stock holdings that you personally would buy if you had a large sum of money. This will allow you to have diverse exposure to the stock market and not have to spend so much time managing your portfolio. I know you're likely wondering, okay, Brian, how is it that you find and invest in the stocks that you pick for your own portfolio? Just between the New York Stock Exchange and the NASDAQ, you're looking at over 6,000 listed companies. And the answer is, I don't go through all of them. I almost always rely on other resources to help narrow down which stocks I should be looking at. As a couple examples, I've paid subscriptions to Motley Fool's Stock Advisor and also Seeking Alpha's Premium. I also follow several stock channels on YouTube and pay into their Patreon subscription. And one of the other things I'll do is I'll spend a lot of time on Yahoo Finance, reading news, and coming up with my own ideas on stocks that I want to invest in, even if I don't hear other people talking about them. It's actually reassuring if I find and invest in a stock myself and then later find that one of these resources recommends it. Now here's a list of things I look at when choosing a stock. Number one, it's really important to look at a stock's past performance. I like to see a stock that has a long history of performing well in the stock market. If the stock has been going down consistently for the last few years, that is very concerning to me. I want to understand why and what has changed in the company or the industry that would reverse its long-term trajectory for me to invest. Number two, what I like to call the industry advantage. What do they have to offer in the industry that's different from their competitors? When looking for a growth stock, we are looking for companies that are breaking the status quo. The big winners will have a competitive advantage, either with intellectual property, proven leadership, or strategic contracts. The third thing that we need to look at is how is the company's industry performing in general. Some industries are not receiving much attention by investors and other industries are literally dying. Even if a stock looks good on paper, you need to consider where the industry is moving as a whole. This is very important when using a long-term investment strategy. Now, number four, where are large investors and hedge funds putting their money? When a stock is receiving a lot of attention from large investors, it's almost always going to get a little bit of a pump. The additional capital can result in more opportunity for industry growth and individual company growth. Don't be blind to the fact that big money moves markets. Their opinion matters. That's why so many people try and follow what ARK Invest and say Warren Buffett are doing. Now the fifth one is which stocks and industries are receiving a lot of media attention. The average investor is not doing a lot of company analysis, but rather just putting their money in what other people are talking about. Warren Buffett said, "The biggest money made in Wall Street in recent years has not been made in great performance, but been made in great promotion." I think that in and of itself speaks volumes. I can pretty much guarantee most people that have bought Facebook stock do not know and understand their PE ratio. Now be mindful of the public perception of the companies that you invest in. This can often affect their stock price more than their actual revenue, but it is a fragile manipulator of the stock price. Surprisingly, a lot of people did well in the stock market over the course of last year. I think we can safely say that it's largely to do with the stimulus and other government policies that are masking some of the underlying economic problems. Something that we will have to face is eventually we're going to have to pay for all of the stimulus money. But even if you made a lot of money investing this last year, I want to remind you to stay humble and base your stock investments off of due diligence and research. Don't let success from this last year influence you to be more speculative in your investments going forward. Find a reliable strategy and routine and stick with it. Now, one of the things that I wanted to cover that I started doing this last year is dollar cost averaging. Dollar cost averaging is when you pick a company that you want to invest in and you have a set amount that you intend to invest in that company. Then you periodically invest portions of that amount until you're fully invested in that company. Now remember, each periodic purchase should be the same amount regardless of the stock price. This really helps reduce the overall risk of your entry point when you're investing in a company. It's used so you really don't have to be very concerned about timing the market. And let me explain why this has been so important in my own personal investment strategy. I've always been one to try and wait for a stock to dip. But if you've done proper research in selecting a company, the stock may continue to go up and may not take a big dip. Dollar cost averaging is an extremely important tool in training your mind to stop worrying about timing the market perfectly. It helps you to get into a stock when you know it's a good company. Now, do I dollar cost average into every initial purchase of a stock that I buy? The answer is no. If a stock has gone up significantly recently, that's when I'll dollar cost average into purchasing the stock. But if there was a large pullback on the stock, or it seems the stock is near the floor of a good resistance level, I'll just buy into my full position. Warren Buffett said, "Our favorite holding period is forever." And if you approach investing with that same mindset, you can still make great returns with much less effort than day trading. I personally know day traders. They spend their life in front of a screen waiting for something that may or may not ever happen. I wouldn't romanticize their lifestyle at all. Yes, some of them do extremely well trading stocks, but most of them have a very standard lifestyle. I think the average person will do much better if they have a consistent income from a job or a business where they intelligently and consistently invest for the long term. Now, if you guys enjoyed this video and found some value in what I shared today, please turn that like button blue. This video literally took me about a week to put together. I have some other great videos coming up soon about investing and personal finance that I think you'll enjoy. If you haven't yet, become one of the original OGs, click that subscribe button and become part of the family. If you have any questions, put them in the comments section down below. I do my best to get back to you, and you guys have a great day.